Hi there, everyone. Hey, I'm sitting here with our Chief Investment Strategist, Philip Peterson. All of you know Philip by now. We're actually in Miami at one of our conferences, and Philip generously offered up some of his time just before we break for lunch. But you know, as it turns out, we have a special person that's here today who is an IG client and a very famous IG client, I might add. We just listened to her story. I'd like to quickly welcome and introduce to you Erika, who is our Survivor 41 winner, the first Canadian to ever win Survivor. Yeah,
Hello, good to see you all.
yeah. Thank you, Erika, for doing this. Yeah,
So this is where
appreciate
the
it.
party's at.
This is where the party starts, and with Philip, the party usually ends as well. Yeah.
I mean, as an IG client, I know how to party, but with restraint, responsibly.
Exactly. Always
Thank
with
you.
Yes,
restraint,
Yeah.
always incrementally, and always with the future in sight.
exactly.
There you know, that was your market statement, I think, today as well, wasn't
That's
it? Hey,
exactly it.
incrementally with the future in mind. Yeah,
Yes.
good segue. Appreciate that.
Amazing. Thank
Yeah.
you for having me, guys.
Thank you, big fan.
Thank you.
Thank you, Erika. Appreciate that. Yeah. Philip, you gave, thank you again, Erika. That was wonderful. Appreciate it. We had a really wonderful talk today from Philip. And the one thing that Philip, as you know, you give us the future, right? You talk about the present, but really it's an eye to the future. And probably the biggest challenge that clients have is not living in the present.
Mhm.
Because we are talking about long-term investing. And so, you know, maybe if I could just bring you back to what you talked about today is, you know, some of the things that have been happening, but more so, how many directives have come out of the White House since the April 4th?
Well, we actually go back to the inauguration date, and since then it's been nonstop. It's been not quite daily, but it seems at least every week there's a couple of new announcements coming out of the White House, and some are reversals of announcements from the prior day or prior couple of days, and it creates a real challenge for investors to try and navigate this, to make sense of it and say, well, where do I invest if this is the future? If tariffs are the future, if a 145% tariff on Chinese goods coming into the US is the future, and the bottom line is you can't.
Yeah.
Because with the inconsistency of the message out of the White House, all it does is confuse the message. And so you almost have to put it aside
Yeah.
and just look at the fundamentals of the broader global economy, or domestic economies here in Canada or the United States, and then also look at market action. And that will often tell you how people are feeling, and when there is a good or better time to take advantage of the swings that we're seeing.
Yeah, the only thing that we know is that there's a lack of certainty. And when you have lack of certainty, like any human, if you don't know what's coming, you feel volatile, right? Well, so are markets, right? So
Exactly.
we do see volatility because of uncertainty, but these are always temporary issues. And the one thing that I know we always talk about with our clients and what I talk about with you, and I'll let you talk a little bit more about what you've done to position the portfolios, is opportunity arise. That's when the good times for us emerge, is when there's volatility, because there's all of a sudden a great sale on high quality companies.
Exactly. And you get these signals every once in a while. So first, coming into the year, coming into a Trump administration, we were more defensively minded in our portfolios, being underweight equities, underweight US equities overall, being a little bit more defensive by having more gold, more high quality bonds, because the tariffs, which is the only thing you could attach to a Trump ideology, would be disruptive and would likely create some volatility in the equity markets, but also some volatility economically. So by being defensive going into the year, we were properly positioned for all the announcements that were coming out. Then we saw an opportunity early April. So when the fundamentals don't work, you have to focus on technicals or other elements of portfolio construction. And so in early April, we started to see significant volatility, like big down days in the marketplace. And it told us that we were near or at peak fear and peak pessimism. Now, you can never predict what Trump's going to do, but the timing was such that we took it upon ourselves as portfolio managers to say, okay, now we want to add back into equities. This is when the S&P 500 was down almost 20%.
Yeah, buy low.
It's like, exactly. When that happens, it's a good opportunity to add. And so we took advantage of that. And very, very shortly thereafter, Trump came out with the announcement of removing the reciprocal tariffs or reducing them down to 10% for that 90-day pause. And the markets have recovered since. So you have to pay attention to these times. They don't come often, but when they do, jump on them.
You know, it's a fundamental positioning, and it's something that I always try to make sure we reiterate with clients. is that, this is active investments. These are not passive investments, but this is an active activity that is happening all the time behind the scenes, because everybody knows you always want to buy low. But it doesn't actually correspond, first of all, when clients have excess capital to deploy, and or there's fear involved, which is very normal, right?
Exactly.
And that is really what they're paying us and paying you to do, is to make sure we take advantage and employ capital that we prepared for, right? And I really wanted to thank you, because the portfolios have been performing extraordinary. And speaking from many clients' point of view, by the way, I started to ask them, right? Right in that sort of mid-April-ish period of time, and I'd say, listen, the portfolios are negative year to date, and I'd ask them, how have you looked? And they go, no, I'm too scared to, right? Which is probably wise. But I said, how much do you think you are down? And the numbers that I was hearing were typically -10, -15% was the expectation. These are balanced portfolios. And they were down in the neighborhood of 1.5% to 2%.
Exactly.
Right? This is to your active management. This is what active management does. And as much as I love, I love seeing this Quest trade ads, and I love seeing these passive investments and that kind. There's a moment in time that those are effective, but this is when active management shines.
Absolutely.
Yeah.
And we've seen that this year with the Magnificent Seven. So the 7 stocks that have been driving the S&P 500 the last couple of years, if you invested in the S&P 500 itself or invested in these Mag 7 stocks, you'd be still underwater this year.
Yeah.
And that is what active management can avoid, saying where valuations don't make sense, you go somewhere else. And I use the analogy, I used to work with a portfolio manager who was a big soccer fan, and he said, if you don't like the field you're playing on, pick up your ball and go to another field. And that's exactly what active managers do.
Yeah, well said. The other last thing I wanted to talk is a little about the future, right? And really what I'm going to talk about more is about the bond market. So the perception is that the administration in the US is holding all of the cards and is, you know where I'm going,
Yes.
right? That they hold all the cards and they hold all of the control. Now, if that were the case, I would argue that you would have seen a lot more volatility in the markets, and we may be sitting in a potentially much more negative position than we are. Because if it was that bad, we should be, but we're not, because there's another game afoot, right? And I'm going to let you take that and talk about the bond market and what is happening, and maybe a little bit of the collusion that's happening around the world that way.
Exactly, and this is that was the trigger point that we would say reversed the policy by Trump on April 9th, when, remember that morning, he sent out a note saying it's a great day to buy stocks. So he was kind of priming the market for an announcement. But we saw the bond markets basically vote on their approval or disapproval of the policies, and yields shot up. Now, this is important for the U.S. government because they are a borrower. They are a net borrower and a significant borrower. It's like $32, $33 trillion in total debt, and about a third of that is being renewed this year. So when you think about what the U.S. government is trying to do, which is borrow at a lower interest rate, the tariff policies are driving yields higher. Bond market is saying, hey, we don't like this. You need to change your policy if you want us to continue to be a lender. And that's when we saw the reversal. So it's coming back to the who's holding the cards. Ultimately, if you're a net borrower, it is the lender that's holding the cards, and they've drawn that line in the sand to say, do not cross.
Yeah,
and that's why we're much more comfortable with the environment through the remainder of this year, because we know at what point Trump's going to back down, and we've seen it. So it's not the worst case scenario that is the more probable. It's the softer side of that.
Yeah, it's been a fascinating time. We've talked about this in the past. You've sat with me, and I know you talk about it, and people have asked me, is this the scariest time that you've seen economically? And my answer to that is not even close. It isn't even a footnote in the things that I've seen in my career. And this is a point in time. This is a change. There's no question about it. But I think what I really want, our clients to understand is that we have this wonderful team that are actively manage these portfolios. They're very proactive in what they do. Defensive going into this year, right? And now slowly getting more aggressive, taking advantage of opportunities. Internationally diversified.
Yes.
And across also many different asset classes.
That's exactly what we're trying to do.
Yeah. Well, you're doing a great job.
Well, thank you.
Yeah. Thanks, Phil.
Appreciate it.
Okay.